Good morning, everyone, from a very cold Joburg this morning, and welcome to another STANLIB webinar. Thank you very much for taking the time to join us this morning. For those of you that don't know me, my name is Dave Watson, and I'm part of the retail distribution team at STANLIB. I think the topic for this morning is definitely one that catches all of our attention as we navigate, quite challenging and uncertain global markets. We look and we think, what is the trajectory for inflation, interest rates, global equity valuations? We've faced with challenges in geopolitics. And in order to address that this morning, we've got three of our colleagues from our global partner at Columbia Threadneedle. Austin, who is a client relationship manager, who will be facilitating a discussion between Neil Robson, who manages the STANLIB Global Equity Fund, and Alex Lyle, who manages the STANLIB Global Balanced Fund. I think at this point it's worth just mentioning that given these are global funds, there's a lot of interest on the local side around Reg 28 and the recent changes there. This naturally doesn't apply to the Global Balanced Fund. So although Alex might not be able to give his exact insights in terms of the regulation, I'm sure he can certainly give some views in terms of whether he's seeing attractive entry points into the various asset classes globally. We hope that you leave the session today with some useful insights in terms of navigating this environment. And just lastly, before I hand over to Austin, I'm just going to cover a bit of housekeeping. Firstly, we have applied for CPD points for this session. So if you would like to be eligible for those, please do stay logged in for the entirety of the session. Secondly, the session is probably going to go in about 45 minutes in terms of the formal feedback, after which we'll have about 10 to 15 minutes at the end to address any questions. So please do make use of the Q&A box. I think we are all familiar with that by now. It should be about sort of bottom left-hand side of your screen. So please, during the course of the presentation, post questions, and we'll try and get to as many of those as we can at the end. Any that we don't get to, your STANLIB BDM will get back to you with some feedback in due course. So with that, I'll hand over to Austin and the team. Thank you very much, guys, for dialing in from London. Certainly, I'm sure a little bit warmer than Joburg today, and looking forward to the presentation.
Yeah, don't count on it, Dave. It's pretty grey here at the moment. But yeah, thanks for the intro. Good morning, everyone, and welcome. To echo David's sentiments, it's great to have the chance to speak with so many of you today. I'd like to give some context to the following 45 minutes. I'll set the scene as to the themes we are seeing play out in global markets and the issues we are also hearing from our clients. So over the session, we will look to discuss our macro views and asset allocation positioning, inflation versus rate hikes, including central bank views, short-term macro sentiment and the forces driving inflation, and the value growth star rotation. So in the interest of time, and without further ado, Alex, why don't we kick off at the top with you and the economic outlook? If I was to pose a question to you, a good place to start would be CTI's views on general economic growth and the outlook for asset classes. If I could also ask you to touch on how we are positioned more broadly within asset allocation as a team. Alex, over to you.
Thanks, and good morning to everyone. And delighted to have a chance to present to you down in South Africa. So that question, Austin, yeah, I mean, lots of questions in there. So economic growth, first of all, I mean, it's definitely a tough world we're in at the moment, no doubt about that, a difficult background. Lots of uncertainty, particularly from the Ukraine-Russian situation. And we're obviously seeing a major squeeze on real incomes from this inflation spike that you and David have mentioned. But I don't think it's all doom and gloom by any means. And I think there are reasons for optimism around. First of all, interest rate rises, again, you mentioned, on everyone's mind. We're starting a period of interest rate rises, so very topical, but we don't think they're going to go up too far. The market is expecting rates in the US to go up to around 3.5%, in the UK 2.5%, in Europe perhaps 1.5%. I mean, these aren't massive rises overall in interest rates, and compared to history, they should be pretty manageable levels. So we don't think they're going up far enough to choke off recovery. So that's monetary policy. Secondly, fiscal policy, government expenditure. We think that will be pretty generous in the years ahead. First of all, we're seeing support packages for economies at the moment, but then on top of that, post Russia, Ukraine, we're going to see a lot of government expenditure on energy supplies. to reduce the dependence on places like Russia. And again, defense expenditure is being ramped up in all major economies for obvious reasons. So fiscal policy will be loose. And also consumers are showing they're very keen to spend post-COVID lockdowns. There's a lot of pent-up demand. People want to get out and enjoy themselves again after a very tough couple of years. So especially in areas like travel and hospitality, you're seeing a lot of demand, and people have got the money to spend. They were forced savers during lockdowns. They couldn't spend. So you've got a fairly buoyant consumer in the short term. And on top of that, we think capital expenditure will be pretty healthy going forward. Companies need to invest. They haven't invested over COVID because of the uncertainties. Now those are starting to recede. And also, given the supply bottlenecks we're seeing post-COVID, companies need to invest to address that issue, to increase supply. And with the Russian sanctions, Western companies need to invest to replace that supply they were getting from there. And with deglobalization, onshoring being fashionable now rather than globalization, again, companies need to invest. So it is a tough background, certainly with the inflation spike, but it's not all doom and gloom. There are reasons out there which will support growth. So we think that the global growth outlook is pretty reasonable. Your next question was on, therefore, asset class preferences. If we look at equities first, that is our preferred asset class. And obviously, we talked about growth. A reasonable growth background is pretty healthy. Secondly, companies have been doing a good job. Corporate results generally have been very strong. Companies have been beating market expectations throughout the recent results seasons, and by quite a long way. In the US, the average company was 7% ahead of market expectations. It's actually higher than that outside the US. So companies doing a good job with profits and cash, out of which they pay dividends, which are so important. And finally, on equities, they're much cheaper than they were. Year to date, the US market is down about 13%, NASDAQ down just over 20%. The European market's down 11, 12%. So there is much better value there. So equities, we think, are the most attractive asset class. If we quickly go to bonds, I don't think it's a bad background for bonds at all. Inflation, we think, will come back down to more normal levels. We've talked about interest rates. We don't think they're going to go up too far. And as we said, a lot of uncertainties. So there will be sort of safe haven buyers for bonds out there. But having said that, valuations, they're better, but they're not great. So bonds would be our least preferred asset class, which just leaves property. And rising yields is not traditionally a good time for property and property shares. And we have seen this year poor performance from property companies. But from here, valuations are quite attractive. The property sector globally is trading on a bit of a discount to its asset value, whereas it's normally on a bit of a premium. So valuations are looking quite good. Property is usually seen as a good hedge against inflation. Demand is healthy, both from tenants and from investors. And importantly, we're finding some very interesting niches for investment in property, areas like logistics, and distribution and storage for all the kit we're buying over the internet nowadays. That's a huge growth area. Companies like Prologis in the USA or Segro in the UK, we think give great opportunities. Residential is another area we think is very interesting. And if we look at the US, you've got a company like Sun Communities benefiting from the demographic changes, the aging population, their retirement homes. And there's other very specialist areas like data center, life science and tech parks, which again look pretty attractive. So of the three asset classes, we think equities come out number one, and we're above benchmark in the global balanced portfolio. Bonds were below benchmark, we think, are the least attractive, but getting more attractive, and property is in the middle at neutral. I'll leave it there.
Thank you, Alex. So headwinds, but not all doom and gloom is what I'm hearing. Neil, a question for you around the US consumer. With consumer confidence in the US low due to high inflation and rising rates, is the consumer still in a good position due to low debt and fixed 30-year mortgages? Second part to that question, if you don't mind. And will the consumer not keep the country out of recession despite those rate hikes? Neil.
Yeah, morning. Yeah, well, Alex has already commented, we were forced savers during a pandemic. And, I think the estimates are roughly $2 to $3 trillion of incremental savings that were accumulated during the pandemic. We're starting to chew through that, and particularly at the low end. But so the low end consumer is under the greatest degree of this discretionary squeeze that Alex talked about. But against that, they've got 10% wage rises at the moment because of what's happening in the economy. I guess the whole story of this is that as during the pandemic, we consumed much more goods than we did before, and as Alex has talked about, we now want to go on holiday, we want to go on, and we're finding all of these bottlenecks that are occurring. So I think the consumer is very healthy at the moment. I think the one thing that we need to watch is that actually I think that tight labor market that developed at the tail end of the pandemic, as companies tried to bid back employees they may have furloughed or laid off, I think is coming to an end. Certainly in tech companies, we're seeing hiring freezes developing quite rapidly. We're seeing some of the more immature tech companies like the Klarnas and payments, etc., starting to lay off 10% of workforce. We had Amazon comment in the quarter that they'd probably overhired during the pandemic and may let some labor go. So I think at the margin, this kind of 3% and a bit unemployment rate may start to tick up during the course of the year. And the speed of that we'll have to watch. But I think in general, Alex is right. The consumer looks reasonably healthy, and therefore, certainly in the US, I think the odds of a recession are probably small, but we are going to have a significant slowdown in terms of growth.
Okay, thank you, Neil. How about I stick with you for the next question, because it's a topic you and I covered in some depth on a recent trip to South Africa a few weeks ago. And it's given the rotation away from growth towards value, which started in late 2021. What are your views on the outlook, and do you see the shift as short term?
Let's take it back slightly longer than that. Let's sort of like see what was driving that growth rotation, as it were, for ever since the GFC. And there was kind of two aspects to it. The first one was, interest rates were low and going ever lower, and clearly that's reversing now. But the other thing was there were an awful lot of structural trends that were driving that, and we can talk about them individually. Many of those structural trends, though, accelerated with the onset of the pandemic. As we all sat at home rather than go out, we did more cloud computing, for example. And so, the growth shares did exceptionally well in the onset of the pandemic, and with it, our portfolio. As you started to come out of the pandemic, two things developed. First of all, we discovered that reopening an economy is not quite as easy as we thought once you've switched it off. Everything's in the wrong place. Labor's in the wrong place. Inventories are in the wrong place. You can't get components to finish your tractor off in the case of Deere. So those sorts of things have been ongoing and caused these bottlenecks, which has led to inflation. I think gradually we're chewing through those issues. And the question is that will central banks let that inflation really build up? And I think it's very clear from central banks, they're prepared to take the risk on economic growth in order to wipe out inflation. So I think that's kind of good. What does that do on that growth value trade-off? Well, I think what's happened is, in terms of the value part of it, the other thing that's happened is that we've had this primary goods inflation in the economy, the commodity related inflation stemming from energy, underwritten by what's happening in the war. So all of that's kind of tightened up those markets. But even then, I think what we're beginning to see is that the the cure for high oil prices in a way is high oil prices, and that it actually starts to squeeze the real economy. So I think that as that economy starts to roll over, I think the secular trends will start to re-emerge. And as Alex pointed out, they're at much better valuations than they were, going back to last September. Salesforce.com last night, they reported stock was up after hours, but that's a stock that's halved. It's not one that's in our portfolios, but there's one that's halved, where you now pay 400 bit times revenues for it. Normally software companies, and I'm talking normal as in pre-pandemic, typically would be trading on somewhere around about 6 to 7 times revenues. So these things have materially derated. I think as energy peaks, as the economy kind of rolls over to a degree, I think we're going to leave a period which we've been in very intensely since last September when rate hikes started. Remember last September, the 2-year note in the US yielded 20 basis points at the beginning of last September. So we've come a hell of a long way. And I think we're leaving this period where valuation has been the issue, valuation risk in all asset classes, but especially in equity. And I think we're reaching a point where actually it's the delivery of earnings that's going to matter much, much more. And it's going to be a tougher economic environment than it was. And I think quality franchises, certainly will start to outperform weaker ones. We saw a bank called First Republic last week. They are a high-touch, high-service bank in the US, grown over many, many years. They have a plan for gaining market share in the downturn that they're expecting. And that's that quality of franchise that we think will start to outperform as we go through the coming months, and as that sort of like slowdown starts to bite. How quickly that slowdown bites, difficult to shout, but I think certainly by the second half of the year, we will see lots of evidence of that. So I think quality will win, and those companies do tend to have superior cash flows that enable them to reinvest and outgrow the market. So I think we will see that rotation. The difficult one is those commodity producers, quite what happens there.
Thank you, Neil. So inflation over recession for central banks, it sounds like. Alex, I know you shared your view, you opened up and shared your views on inflation and interest rates, but I guess a more narrow question with the Fed raising rates to 20-year highs, would you expect this to trigger a sharp economic slowdown? And Neil, if you could chime in at the back of this more at a company level, that if the Fed is forced to hike more aggressively, what do you see the impact on global equities?
I don't think the Fed will overdo it. As I mentioned, market is expecting the Fed to raise to perhaps 3.5%. I don't think that should be enough to really snuff out the recovery. As we said, there are some underlying trends that are still reasonably encouraging on growth. One point they've consistently made is that they will consider economic conditions, and if they see the economy slowing down too quickly and inflation being removed from the system, I think they'll slow down. I think we could well see interest rates rising less far than markets are currently discounting, because economies will do part of it for them. As Neil said, they definitely want to get inflation out of the system. And just to sort of echo a lot of what Neil said, I do think that the inflation we're seeing around at the moment is fairly focused it's very focused in two specific areas. One is post-COVID issues, and the other is post-Russia-Ukraine issues. So things like, post-Russia-Ukraine, it's energy prices that are up sort of 30-40% wherever you are, and it's some important foodstuffs. Obviously, we get a huge amount of wheat coming out of Ukraine, a lot of fertilizer coming out of Russia, which is causing big price rises in some foodstuff. I heard yesterday in the UK that basic pasta in the supermarkets has gone up by 50% in the last few months. So big moves, but very focused on these particular issues. And likewise, we've talked about the post-COVID euphoria, getting out of spending. Sea travel and air travel in the UK are up by about 18 to 20% at the moment, in price terms. So again, it's very focused. And I think these issues will be resolved. the post-COVID euphoria will die down, and B, the system will respond to make good the shortfall from Russia and Ukraine. I mean, already we're hearing Argentina's planting a lot more soya. There is a huge amount of expenditure on energy supplies to make good that export from Russia. I mean, in the UK, we're issuing new licenses for exploration in the North Sea. Having said we wouldn't do any fracking, we are now opening the debate again on fracking. We're extending the lives of our nuclear plants. So, I mean, it takes time, but we will get the energy being produced, which should get the inflation down. So coming back to the question about the Fed, I think that inflation will come out of the system. And again, to reiterate what Neil said, wage inflation is the worst sort of inflation. Once you get it into wages, companies have to put up prices and so on. But it seems that we could well be past the worst in wages. And Neil mentioned a number of American companies getting into trouble that are cutting back. So I think inflation will come out of the system. So I don't think the Fed will have to raise too far, and probably a good chance it'll be less than what the market's discounting. So I'm reasonably optimistic on that front.
Thanks, Alex. Neil, the second part of that question was, assuming there might be a more aggressive hike by the Fed, what do you see the impact on global equities to be?
Yeah, well, I think, as Alex has mentioned, I think the odds are probably limited, but it's a possibility. If you want to just be really mechanical about it, if you run a DCF valuation on a company and you add 100 basis points to the cost of capital, then roughly the fair value comes down 12-15%. So that would be mechanically what would actually happen. But I think the other aspect of it is the feedback loop into the real economy. We are already seeing the impact of rate hikes changing behavior and changing, how the economy is growing. The most obvious being housing. If you want to take on 30-year mortgage in the US, as you commented, something like 90% of all homeowners actually have a 30-year mortgage. It's now over 5%, about 5.25%. That's much more expensive. There is now sticker shock on pricing, and as a result, you look at the share prices of home builders. They now trade on 1x book value, which is about as low as they get, apart from in a period post GFC when they were writing off an awful lot of that book. So the traffic running through the housing developments, etc., is dropped materially. The housing market is cooling very, very rapidly. I think something like 20% of all houses on sale now actually have reduced price at least once. So we're getting, if you like, that froth from the pandemic is coming out, another inflation trigger that is reversing. So these impact, hiking has an impact. It's having an impact on the behavior of companies as well. And as a result of that, they're going to be more cautious in their spending patterns. So all of this is going to start to ease the inflationary problem. So it is having an impact. The debate is how high it has to go. I think 3.5 is having real economic consequences. I think the oil price is doing a lot of the work of the Fed. Does it have to go materially higher? I agree with Alex, probably not.
Good, thank you. Sounds like the system working efficiently might wash some of that out. So Neil, we'll move to you, or we'll stick with you actually, and talk about tech exposure in your portfolio, if you don't mind. And the question more broadly is, do you see these companies being able to hold superior earnings growth even through the slowing cycle? And any examples you can talk of companies which you hold or don't hold would be helpful for the discussion. And a secondary question, which you might want to weave into the answer, is what will be the trigger to turn around investors' negative sentiment for big tech?
Okay. Tech companies are not immune to slowdowns, would be the first thing I would say. Just following on from our last point, if you think about the impact of rising cost of capital. So we've had a substantial rise in cost of capital since last September. It's already having an impact. Sequoia Capital, which is the Menlo Park-based Californian venture capital business, they're one of the largest venture capital investors in the US. They held a call for their 200 plus companies that they're invested in a couple of weeks ago. And what they were saying is actually, this is a moment where you need to be, burning cash is no longer an option. You need to conserve your cash, preserve your balance sheet. You need to think about, if you like, there's been this, while capital was free over the last 10 years, companies were paid to grow and become profitable later. Now that cost of capital has gone up, the market is less tolerable of that duration, and therefore we'll want to see more cash flows and earnings closer. And therefore, these companies should start being run more in line with becoming profitable. Salesforce last night is a great example. Yeah, there's a business which actually generates free cash flow, but only has single-digit operating margins. At maturity, if they weren't trying to grow as fast as they are, they're still growing at 20%. That would probably mature around about a 25 to 30% operating margin. If you ran that through the business, it would be materially cheaper. So these companies, I think tech companies will start to slow down their growth because there is a trade-off between growth and profitability. If you're a software business making 80% gross margins, the reason you're not profitable is because you're choosing not to be profitable. I think that what's going to happen over the behavior-wise over the next 18 months is they're going to choose to be profitable. That will slow down the tech ecosystem, as it were. It will probably slow down demand for semiconductors and all the way through. But that's a common problem across all of the economy. I think there's also, we've gone through a period where it was very hard to get semiconductors, for example. I'm sure there's been some over ordering. I'll order twice as much in case the next lot doesn't turn up. And normally when you start to slow down, you discover how much over ordering has actually occurred. Again, you can see it in the Walmart results and the Target results of stuff that they ordered that by the time it actually arrives in the shops actually isn't desired anymore. It's arrived at the wrong time because it took 110 days to get across from China. So this inventory issue goes across the whole economy, but it will impact tech. So tech will slow down, but I think the growth rates that are there are durable. I mean, we talked when we were down in South Africa recently about Microsoft. Cloud adoption. Cloud is gradually taking more and more of enterprise workloads and is growing as a result, and is still growing. 40% in the case of Microsoft Azure, 30-odd% in the case of Amazon AWS. So it's still rapidly growing. It's only about 10% penetrated into enterprise workloads. So there's still a long runway of growth. Why is it growing? Because it's cheap. It does two things. It's materially cheaper than your running servers down in your basement, and it also enables you to rent. So you actually rent space. So it creates, instead of having a fixed cost down in your basement, you have a variable cost. Now, the world gets tough. Actually, the first thing you're going to do is probably stop all spending. The next thing you're going to do is work out how you're going to cut your costs. And that will accelerate cloud adoption. In the case of Microsoft, they're growing revenues year over year. The latest quarter was 17%. It's gradually accelerated over about the last 10 quarters, just because cloud is becoming a bigger portion of the business. Now, that stock used to trade on 30-odd times earnings. It now trades on 23. At 23 times earnings, I think this business probably grows mid-teens. And if it's wrong, maybe it's a couple of percent lower than that, which roughly means it doubles its earnings on a 5-year horizon. So if you think about Microsoft, 5 years' time, it will be trading on 11 and a bit times earnings. I don't think so. I don't think it'll ever get that cheap. Bond yields would have to be crazy for that to occur. So I think that secular development that's ongoing there will make sure that Microsoft outperforms. I think its fundamentals will outperform the broader economy. And I think its valuation is cheap enough that it can now start. What triggers that is a really good question. I wish I had the immediate answer for that. I think really what will trigger it is that things will stop delivering in other parts of the market. If you look at it, essentially what's happened since last September, people have left tech and left growthier areas and gone off and bought things that are very high cash flow at the moment, which is commodities, particularly energy. I think in the year to date, the spread between tech and energy is somewhere in the order of 70% in terms of returns in the marketplace. It's almost the exact reverse of what it was in the first 9 months of 2020 with the onset of the pandemic. So an awful lot has occurred. Oil prices will ultimately cure themselves. Remember, part of this is self-inflicted in terms of sanctions. Alex talked about all the investment that's accelerating in these areas. And ultimately, one of the reasons why oil companies had got maybe arguably cheap by the end of last year was the fact that actually, in 20 years' time, maybe we'll have stopped using it to drive around in. So, that there is if you like, they are short duration assets relative to tech, which is longer duration. So again, that duration impact, if we start to see that peak in interest rates come into view, and I think we will in the next, probably between now and year end, then I think that will also trigger a better environment in terms of growth. Are we going to go back to the period, post GFC, where there was one bet and one bet only, and it was growth wins every single time period? I suspect not, but I think it will certainly become more balanced, and probably over time, the secular winners will start to come through again.
Okay, thank you, Neil. Very interesting. Alex, why don't we finish on with you, with the global fixed income outlook? I know you touched on it in your opening sequence and how we don't favour global bonds at the moment, but I guess a more pointed question is, given global bonds are experiencing the largest sell-off in many years, how do you go about managing the risk in that space?
Yeah, I mean, as you said, I mentioned that we haven't been enthusiastic about bonds for a long time now. We prefer other assets. As I said, equities and property look more attractive. But still, I don't think it's a bad background at all for bonds. We've said interest rates aren't going to go up too far, we don't think. Inflation, we think, will come back down to more normal levels given a bit of time, and that there will be safe haven buyers, more so now than there were 6 months or a year ago. In the uncertain world we're in, bonds do have that attraction. And I think there's better value now, without doubt. As you mentioned, bonds have been a very disappointing performer. And if you look at government bonds, a 10-year treasury in the US is yielding 3% now in round numbers. A 10-year gilt in the UK is just north of 2%. I think those are starting to get much more interesting. And within government bonds, treasuries, we think, are one of the more attractive bonds. The European periphery, which tends to trade at quite a yield premium to the core of Europe. And those differentials have been narrowing, we think can narrow further. So places like Italy, we think, are quite attractive areas to invest in. If we look at corporate bonds, the spread there at about, globally, you get about 1.5% more on an investment grade corporate bond than you do on an equivalent government. And that's a reasonable carry. I.e. reasonable extra bit of income to pocket each year from holding it. And we don't think the risks are too high. Corporate leverage has come down. Companies have sorted out their balance sheets. Interest cover is looking pretty healthy for the companies involved. But having said that, one has to recognize that the risks have risen. Although we still think quite low, they have risen. We've talked about slowing economies around the globe, and that's not good for companies' certainty of repaying their debt and the interest. So we think it's reasonably attractive corporate credit, but the risks have risen. So we're pretty neutral now between corporate bonds and government bonds. And overall, we are a bit keener on bonds after we've seen the rise in yields, but still, it's not our most attractive asset class. And we'd prefer to have our overweights in equities and a more neutral position in property.
Thank you, Alex. So interesting, but just not quite there yet. Well, look, on that note, I thank you both, and that was fascinating, and I hope you in the audience all found it useful too. I'll conclude and summarise what I've heard today, and then hand over to questions for Dave. So effectively, there's lots of uncertainties and risks still, but on balance, the growth outlook is reasonable. Inflation should return to normal levels. We don't believe deep value will continue to outperform, and good companies with strong pricing power and competitive advantage will succeed in a world of rising inflation. And finally, our long-term track record and disciplined process stands us well to outperform through the cycle. So I'm going to pause there and hand back to David for any questions you have for Neil or Alex.
Yeah, thank you very much for the feedback. Very insightful. We have had a couple of questions come through, so I'll try and direct them appropriately, but I think also if Neil or Alex, if you've got additional comments, just jump in. I think always from our side, there's an interest in what is the view on South Africa from the outside, and specifically a question here around what is the view on SA bonds from your perspective. So Alex, if you can potentially give us a few comments there, if you have any.
Sorry, just unmute. Be perfectly honest, it's not an area that we don't hold any South African bonds. It's a small bond market compared to the rest of the world. We don't think things look, you're getting a good yield without doubt, but you certainly got higher inflation there than you have elsewhere. And obviously there's currency issues as well relative to elsewhere. So it's not an area that we find desperately attractive, I'm afraid. But it's quite a small market, and I'm not the world's leading expert on it.
Okay, thanks. Another one here, also just sort of on the emerging market side, but I guess speaking more to the equity side. So potentially, Neil, you can just comment within your portfolio, any views within emerging markets, and potentially more broadly than that, also looking to your allocation to North America. Has there been meaningful change in that exposure in recent months, or is it largely the same?
Okay, thanks. I mean, first point, we buy companies, not markets. So everything we do is from the bottom up. So I just reinforce that. In terms of where it's led us, we have actually reduced North America tail end of last year. So actually our North American weighting is about neutral, which is the lowest it's been in a decade, I would say. So, that has changed. In terms of emerging markets, two things that kind of occur to me. Well, emerging markets are not a uniform block. So if you think about what's happening in the world at the moment, interest rates are going up. When the US raises rates significantly, normally an accident occurs somewhere in the world. And quite often it's in one of the emerging markets. So if you're an emerging market where your currency is linked to the US dollar, so your rates are going up, and you happen to be not a commodity producer, then the squeeze on your economy is very, very intense from what's happening. Remember in terms of energy, energy intensity of GDP, ag intensity in terms of your consumer baskets, it's probably at least double what it is in Western world, and therefore the impacts are much, much stronger. So, I think we're a little bit cautious on emerging markets. South Africa's lucky. You export an awful lot of commodities, and that's helping pin in the currency. And because the currency is locked, maybe the inflation consequences in South Africa are a little bit less than you might have elsewhere. But it is a riskier environment, we think, for emerging markets. Then, coming down, to the bottom up, which is what we do. When you look around, you look at the major, emerging markets. The dominant one has been China. And at the moment, well, we haven't invested in Russia for forever because the risks were just too much. There is a growing debate, ever since 2018, Trump-inspired Cold War with China, trade war started. There is a growing issue in terms of, do we feel safe investing in China? The Chinese have not helped themselves because if you've seen what they've done to their tech sector, for example, ever since probably the Ant Financial IPO, which they got in the way of, changing the regulations literally in front of an IPO. They annihilated their education sector because of changes in regulations overnight. What they've done, you guys will all know Tencent because you all follow it intensely. In terms of regulations and gamings and so on, and what that's done to growth rate of that business, which is essentially removed growth at the moment. So in the Western world, we might look at the US, we might look at the US mega caps and say they need to be regulated. We need to do something about their dominance. But we have a rule of law, which means that it happens slowly. We see it happening, and maybe in 10 years' time, something will have changed. In China, it can happen overnight. So that makes us a lot more concerned about some of the major market caps within the emerging market area. So emerging markets, not really a favor with us at the moment. We do have selective investments in places like Indonesia, in India, and then I guess some of the tech investments necessarily, the likes of Samsung. I don't really think of Korea as an emerging market there.
Thanks, Neil. Yeah, I think you preempted. There was a couple of questions specifically around China, so I think you've you've addressed that as well. Another question here, just saying on rising yields in the US, would you expect a strengthening of the dollar over the medium term? And how do you think the dollar looks stacking up against other major currencies over the medium term?
Do you want me to answer that one? I think the dollar looks fairly attractive at the moment. I mean, just short term, we are actually neutral on the dollar because it has been so strong. But if you look further out from here, I mean, the US economy is a strong economy relative to the rest of the world. It is reasonably isolated from the Russian-Ukraine situation. It is independent of energy. So it's good from that point of view. And having talked about interest rate rises not being too much anywhere, but they are going to go higher in the US than most places. So 3.5, as we said, which is going to be one of the highest for the major economies. So, you know, you've got a decent interest rate option when you go there, and it's a good, healthy, strong economy, and it's an attractive place to invest. There's a lot of very good companies over in the US and a lot of very interesting industries. So I think for the medium term, the dollar still looks like a pretty attractive place to be.
Thanks, Alex. Another question here, probably for you, Neil, just around, do you think the record margin levels in the tech space are sustainable, and why, given that historically they do tend to mean revert regardless of technological developments?
Yeah, I break that down into two aspects of it. You know, in terms of software margins, they tend not to mean revert. You know, software tends to be a very high renewal rate type business. You know, if you're Microsoft, you probably can count on at least 90% of your revenues reoccurring into next year. Once you reach that sort of maturity, your margin structures tend to be very resilient. In terms of semiconductors, they are the opposite. They're the most cyclical element of the business. What we are observing, however, is that, you know, I think margins may well be somewhere near peak in semiconductors at the moment, may well drop down if we have a semi cycle, if that inventory issue is a real one. But over time, what we're seeing is that those margins are going structurally higher and have done for really about the last decade. And the reason behind that is because market structure is changing. You know, if you want to buy a DRAM or you want to buy, you know, NAND flash, you're going to 3 people around the world. You know, if you went back a decade or more, there would be at least 2 to 3 times as many people supplying. So as you've got that concentration of market, the margins have structurally sort of going up. Where margins fail in tech is normally because another technology comes along and does it cheaper, better, and removes your game, as it were. What's happening is that, you know, over the last decade, capital was free. We threw huge amounts at the wall. You know, the number of payments companies that were launched and came to market with an idea of trying to disrupt MasterCard and Visa. You know, those types of things are happening. You know, that's Schumpeter's creative destruction, as it were. One of the good bits of the last, you know, 9 months as interest rates have gone up is that actually capital has been choked off. And as capital is getting choked off, the resilience of some of these franchises over the coming years is actually probably improving. It's difficult. If you cast your mind back to 2000 and, you know, the real tech bubble, what we've gone through was not anywhere near what we had back then. But if you sort of like managed in the tail end of that tech bubble, you know, as it burst, if you managed to pick up the few companies which actually did compound out thereafter. So, you know, we've held Google since 2005 continuously. Google at that point, I think when we bought it, it was trading on 17 times revenues. So in the context of, you know, the mid 2000s, that was a very spicy multiple. It didn't matter. Why didn't it matter? Because they've compounded out revenues and growth, revenues, cash flow, and earnings at a rate of 24% per annum ever since. So you've grown in. You know, the tech bust that has gone on, there are lots of smaller tech companies that are down, you know, share prices down 60, 70% from last autumn. Some of those will be the ones that make you rich over the next decade. Some of them will just disappear. So in terms of kind of that tech margin, I've drifted away from that question. I think it depends on the parts of tech. Tech is a very diverse area. But I think one of the things that we're looking at, we have, we are invested really in the if you like, the dominant tech companies of the moment. I think one of the things we will look at as this bloodbath continues is trying to pick up the dominant tech companies of the next 10 years. And it may be software businesses, it may be cloud software, which used to trade last year at ridiculous 20 to 30 times revenues, and you can now pick these things up on 10, 12. And if they compound out growth at 20% plus the way that Google did, then these become the really cheap stocks of 5 years time. So I've gone away from that, but I think our excitement is that actually the potential is still there. But probably for 80% of the companies that came to market, they'll disappear. They'll either not work, go bankrupt, or get absorbed by other businesses. If I was MasterCard sat there now, I'd look at a lot of this tech payment startup companies and think, which ones do I want to buy? I hope that answers.
And I guess it comes back to that point you made earlier in terms of it's become a lot about finding the companies that are able to deliver on earnings going forward. That's really what it's come down
Absolutely.
to.
Yeah.
And I mean, I think you've sort of preempted this question in your last comments. Then it's to that same point of who will be around in 5 to 10 years time, and it speaks about what is your views on the future of online payment companies. For example, PayPal. Do you think that the market is too competitive in the space, and is it likely that just the large companies will actually prevail in the space?
Yeah, I mean, payments is really interesting. Yeah, if you went back 18 months ago, it was pick a payments company, any payments company, they all went up. And now we're in a phase where they've all come down. The online payments companies, remember, had an exceptional pandemic. So they've all got all these problems of year-over-year growth comparisons. And that's come through in the likes of PayPal, etc. I think there are too many of them. I mentioned Klarna early on, which is one of these payments businesses, have just cut their workforce 10%. Why they cut their workforce 10%? Because business is slowing and they want to preserve their balance sheet. Will Klarna still be here in 3 years' time? Maybe not. But would a PayPal or a Square become the dominant payments company online? These are the sort of questions that are very hard to answer at the moment. But we need to watch for these, if you like, competitive advantages developing. What I will guarantee is that over the next 3 years, the space will probably become less competitive than it has been now. And we will spend a lot of our fundamental research time examining that problem. Are we in a position to decide what the answer is today? Probably not. But we want to make sure we're alive to the possibility that this is an area that might make us a lot of money. And it's true in a lot of areas of tech. And it's, remember, it's not just tech, it also includes areas of healthcare where there's an awful lot of innovation going on. But I think that funding of innovation is going to be challenged over the next couple of years. And that will necessarily, if you like, lead to that creative destruction, which will ultimately produce the winners.
Just a question here. There's a couple that I'll try and put together in one. A couple of questions around ESG, which is obviously top of mind, I think, for all investors at the moment. But this specific one, it says, is a rethink needed in support of ESG considerations as the theme skews congested capital, yet leaves dirty industries, which still have a medium-term lead time of low supply, high demand, and high profits?
Yeah, I mean, it is having a major impact. There again, it's supposed to. Yeah, we need to decarbonize the world. So, it has to have an impact on capital allocation. If it doesn't have an impact on capital allocation, then we've all got other issues. Will Cape Town still have water? All those sorts of things. So, it's there for a reason. I think, managing any transition is always very, very difficult to make sure that the supply of everything is adequate at all times. And it's an incredibly difficult challenge. And what we're going to see is spikes in the oil price like we've got today, because oil companies are underinvesting their businesses at the moment. If you look at, say, the oil and gas patch in North America, the shale area, that is probably the area that should grow. It's one of the lowest cost structures around the world. over the last couple of years, businesses have, the old days, they used to grow as fast as they could. They were like tech businesses. Give them a bit of cash flow, they'll borrow a bit of money on top of the cash flow and invest 120% of their free cash back into the business. They're now all sat there saying, right, we're going to invest 80% of our cash flows and we're going to give the rest back to shareholders. And it was the market who said, be capital disciplined. Now, the question is, at what level of oil price do they kind of go, away? We're going to start reinvesting because we can make a serious amount of money out of this, and market forces will work. And the high oil price of today may become the very low oil price of tomorrow. We've got an investment in a business called Equinor, which is was the original Norwegian state oil business. We had a conversation with the CEO probably a couple of months ago now, and he was just, he's under an awful lot of pressure to give cash back to shareholders. And as he was saying, he spent the first 9 months in the job negotiating with the Norwegian government for state support to keep the business running because the low oil price was killing it. So that we will go through feast and famine. We need adequate investment in oil and gas, but we need massive investment in other areas like wind, solar, etc. Part of the consequence of the Russian invasion of Ukraine is that the EU now needs to wean themselves off Russian gas. And you talk to all the utility companies, there is now a definitive plan. It's going to take 5 years, but there is a definitive plan to do it. They are changing regulations to allow, at one point, if you want in Germany to put on an onshore solar or onshore wind, it would probably take you 3 to 5 years in terms of permissioning. Now they're guaranteeing that your permissioning can be done within 12 months. So they're changing the rules to enable this. Russia will be poor in the future as a result of this, because I genuinely believe on a 5-year horizon, substantially all of Russian gas will no longer be required in Europe. So that it's running away from ESG, but it is really talking about the amount of investment that needs to be done in electrical utilities and places like that. How that ESG gets put across, I think, is an interesting one. There is the blanket ban approach. So this company, this electrical utility has some coal exposure, therefore you're not allowed to own it. I think that's wrong. We have an investment in NextEra in the US. They are the utility that is doing more to decarbonize the US than any other. But they do it by actually buying up other utilities, taking on their coal-fired power stations, then closing those power stations and converting them to wind and solar, because it's operationally cheaper to do it. So a business like that should be encouraged, not penalized. So ESG, I think, is in its infancy still. There are lots of issues to be looked at, but this transition is a really difficult one, and it's one that's going to be dominating our investment lives for the next 20 years.
Yeah, and I suppose also an area that isn't just clear cut. I mean, I suppose it's not about just screening, as you say, completely negatively for as a business stands today, but you've actually got to consider what is the direction of travel in terms of the operations on an ESG basis.
Yeah, we call it intentionality.
Okay. Maybe just, and again, bringing a couple of questions together here, and I suppose this is the tail risk, and we've spoken about it a little bit in terms of inflation and interest rates and where you guys feel that is going. But in terms of that, what does it mean for portfolios, that situation where potentially, inflation becomes a little bit more of a longer term problem? Countries are forced to push up interest rates a bit higher than currently anticipated. Obviously quite a tricky question, but any views on what that means for portfolios? And Alex, you maybe can answer. I know you alluded to earlier, the risk of, as inflation becomes embedded, specifically in the wage space, it gets a little bit harder to actually contain.
Well, certainly it does. Yeah, I mean, if it's not our central view at all that inflation does become embedded and last, but it is definitely a risk out there, and we are certainly looking out for that. And if it does, it definitely does have implications for portfolios. The sorts of companies you need in that environment are well, first of all, companies with pricing power. Pricing power is so important. In inflationary times, can you put up your prices to cover your rising costs? And some companies are making special products that we all need to have, and they can push up prices. Other companies are making things that we don't necessarily need, so we can do without if the price goes up, or there's lots of other companies producing exactly the same sort of stuff, so we get it from someone else. So pricing power is something we really search for, and that is essential in an inflationary background. And companies that can control their costs. If you've got wage rises, can you replace some of that labor with machinery? And I think there will be plenty of scope for that in the future. Technology is developing. Companies, as we've said, haven't invested much in new equipment, new facilities, and going forward, they should be able to. And I think there's some fantastic developments taking place, which will increase productivity around the globe. And if you can do things with drones rather than with people, that will help save your costs. And I mean, in the UK, we're seeing the Royal Mail, the postage delivery system, is delivering to some of the Scottish Isles by drone now, rather than sending a man on a boat. That is great for cutting costs. We are seeing already supermarkets doing deliveries on a small scale, a practice scale, with robots. So, again, if you can stop having that Sainsbury's van or a Ocado van driving around the place, and you've got a little robot going down the pavement delivering stuff, that will help save costs. So those are the sorts of things you need to think about in a rising inflation background. And also, if interest rates do go up too far to control inflation and the economy gets tougher, you need the quality companies that Neil's been talking about, strong companies, and more defensive companies. And we know the sorts of defensive areas, utilities, which we think are pretty dull by and large, suddenly become more interesting.
I think if I may come in, just on this inflation thing, tail end of the pandemic, there was an excuse that everyone could take price. Okay, for the first time in decades, you could raise the price because you hadn't lots of excuses, and everyone knew their suppliers were facing cost issues and all of those sorts of things. But if you look at something like Coke, Coke raised prices, I think year over year in the last quarter, I think it was something like 8 or 9% was the price mix impact on Coke. So mix impact is just the fact that they shrink the size of the can that you're drinking it out of. Will they be able to do that again next year? And I think the answer is no. I think there was a one-off opportunity for people to take price, and then it's going to go away. You go back and have a look at what Walmart was saying on their conference call after the earnings numbers. They now want to work with their suppliers in order to make sure that things are affordable for their customer base. And working with their suppliers is basically them strangling them. So I think the ability of companies to do it a second year is going to be really severely constrained. People now worked out there is a problem with inflation. The central banks worked it out, the companies have worked it out, and they're trying to do something about it.
I think the other point to make about inflation is, one of the fantastic deflationary forces that's been around for a long time now is the availability of price comparison. Neil mentioned Google. We can all, whenever we're buying anything, go onto the internet and look around and see where the best price is. And that really limits companies' scope for raising prices, because if they do, you can usually look around and find it cheaper elsewhere. And disintermediation, removing the middleman, that just continues the whole time. Again, helped by Google, we do far more ourselves nowadays, and cutting out that middleman, that agent, again, keeps costs down. So I think the deflationary forces that have been at work over the last 20 years are still there, helping keep inflation under control.
Thanks very much for those views. I think very, very helpful. I am mindful of time. We've got only 1 minute left, so I think let's leave it there. As I mentioned at the beginning, any unanswered questions, we will get back to you via email or phone call. But thank you very much to the team in London. Thank you very much for the feedback, taking the time. I think a long-standing relationship with Columbia Threadneedle, and it's certainly stood our clients well to be invested in the portfolios which you guys are managing on our behalf. So much appreciated as always. And thank you for making the time for these engagements. To everyone on the call, thank you for making the time this morning as well. We hope that you found it useful. And as always, reach out to your STANLIB BDM if you've got additional questions or if you want to chat about any of the funds in more detail. Thanks very much for the time.
Appreciate it. Thank you, everyone.
Thanks, Dave.
Thank you all.